All right, everybody, all you everyday traders, welcome to another episode of the Everyday Trader with me, Eric Hale, and also with Greg Jensen, CEO of OptionsANIMal. Today, we want to talk about something that was, we promised we would touch on this a little bit last week. We said we'd talk a little bit about the yield curve and what it is and why it's important. And yeah, let's start with that. First of all, any update? How was your weekend, Greg? Anything exciting going on in your household?
Pretty quiet, to be honest. Trying to convince my wife to start a bakery, but I don't know if she'll agree with me on it, but we'll see. She's got a gift, by the way.
I know. I have seen photos, and I've actually talked with your wife about sourdough recipes, and I've seen pictures of her baking, which is absolutely artistic. So that would be exciting if that's.
We'll see. We'll see. I bought an oven for her, so we'll see how it goes.
That should be fun. Well, I'll have to get myself some bread the next time I see you.
There you go.
So we wanted to talk a little bit about treasuries, and you hear things about the yield curve and maybe yield curve inversions, and we just wanted to address that real quick. So the U.S. government, part of the way that it helps fund itself is by loaning or borrowing money from people like you and me. And they do they do treasuries, which have different names and different terms. And there's everything from a 1-month treasury all the way out to, I think, 30 is 30 the max. I know that in Switzerland, they have 100-year treasury.
Yeah, they have a few hundreds, but 30 is the norm.
For the max, right?
Yeah.
For a treasury. So this is from the U.S. Treasury, not the Federal Reserve. And the reason why this is getting a lot of attention is, first of all, the treasuries themselves, the different, when we look at different treasury yields. So this is going back a couple years for the 10-year treasury. These can be seen as indicators from either, am I sharing that right screen? Are you able to see that there? Yeah, I think you should see it. Okay.
Yeah.
So you can?
Yeah.
So the treasuries can be an indicator of things that are going on in the economy, good or bad. Sometimes we can make sort of predictions based on what's happening in the treasury market. And you probably hear a lot about the 10-year treasury being an important indicator. And here's the long-term chart. Well, this is all the data that I had. This isn't, I guess, max. We only go back to 2003. That's not a long-term. So, Greg, real quick, explain that's the wrong one. That's not that's an inflation adjusted yield. But explain real quickly why the price or why the yield of a 10-year treasury or any treasury would go up or down. Why does the yield change?
Well, to answer it really simply, it goes back to the old economics 101 conversation of supply and demand. If there's a lot of treasuries that are issued for sale, and not a lot of buyers that want to buy them, then the price is going to go down on the actual dollar value of the treasury. Now, what that does, however, is causes the rates to go higher. So it's a little bit inverted as to normally what you would think. The actual price of the asset, the bond, if it goes down in value, the yield on the bond actually goes up. And so that's typically what people think about when they think of 10-year treasuries, is they think of the yield associated with it rather than the nominal value of the actual bond itself. And so typically, again, if you have people selling bonds in the bond market, if you hear them talking about selling pressure, well, interest rates then, or yields, are going higher while the price is going lower. And that's why over the last couple of years, we've seen, and I'm going to ignore this 6 months, right, where we've actually started to see interest rates increase again. But for the 2 years previous to this, in fact, arguably you could even say clear back to 2008, this was the case, but definitely the last 2 years since COVID, is there has been a huge buyer of bonds in the bond market. The marginal buyer has always been the Federal Reserve. The Fed has stepped in where other governments or investment agencies or individuals or whoever it was who normally may have been a buyer of bonds, the Fed has stepped in and propped up the prices of bonds, which meant the yield has gone lower. And so that's why interest rates have been so ridiculously low. That's why mortgage rates have been so low. Interest rates on credit cards. This year, we're finally seeing the opposite because that marginal buyer, the Federal Reserve, is stepping away. They're no longer buying bonds in the bond market. They're letting the true value or the price or the demand, I should say, for bonds set its price. And that's why one of the reasons why you're seeing bond prices going down right now and yields going up.
Well, you went a little deeper than what I wanted to get there, but that's fine because that's all important stuff that we wanted to talk about. The point that I was trying to make that I wanted to communicate is with the bond price, when we see the yield going up, it means the price has actually gone down. So you can think of, you get paid the same amount of money. How much does it cost you to get that? So if the yield is going higher, it means you can buy that bond at a lower price and you get the same amount of money back. So it's the price that changes. The payback is essentially the same. And what I'm showing here, and this is the tail end of where we've been, and I've got some longer term data to show in here that we'll look through this. But this is the 10-year Treasury, which through 2000, this data starts at 2019. And this is data that I downloaded directly from the US Treasury. These spreadsheets are available. If anybody's really interested in the spreadsheet, again, I'm happy to share the link with you. I've done some of the work for you. But the UStreasury.gov makes this data available and you can download it. Here's the website that'll come up to. So you can go to the home.treasury.gov and then you can go to data and there's all kinds of stuff if you wanted it. But if anybody wants this spreadsheet, of course, it'll be out of date tomorrow, but I did update it. So it's as of yesterday. We've got the last, we've got the data from yesterday in here, or actually from Friday in here. So this is looking at just the 10-year. I've tried to filter it to clean it up, but often what we do is we compare multiple expiration or multiple treasuries. We look at the 10-year. We tend to look at the 3-month and the 2-year. And looking at what you see here, we've got the 2-year, which is the green line, and the 10-year is that yellowish line, and the gray line is the 3-month. And what's getting all of the hullabaloo lately is the fact that the 2-year yield is now above the 10-year yield. And this is what people are talking about with an inverted yield curve. And another place where people will look at this is Fred, which is from the St. Louis Federal Reserve, does a really nice job of making all kinds of data available for you. For those of you that are, maybe you've got a cocktail party coming up, it might be good to come here and download some of this data so you can bring it to your cocktail party. But the 10-year and the 2-year yield, this is what people are looking at and seeing. We can hit the max here and see. I was going to say,
but it depends on who you want to impress at the cocktail party. You may want to know the score of the Bears 49ers game, right?
Yeah, that's yes, it could be like Raid for women. It keeps them away.
Yeah.
If you're trying to, no, I was being a little sarcastic there, but historically we go back, and this data goes back to the 70s, looking at the 10-year and the 2-year, and the gray bars are recessions. And when we've had inversions, we've seen several inversions that have happened, which ultimately sort of corrected and came back. And back in 2019, there was a little bit of freaking out that was going on here. So we want to dive a little deeper. We've got some data to share that talks about, is this the 2-year minus the 10-year? I think it's an important number, but in terms of prognosticating a downturn in the economy, I prefer the 10-year minus the 3-month. And if we look at this signal, so if we compare the two, we don't have as much data for the 10 minus the 3-month because we didn't have 3 months that went back in the 70s. The 3-month was introduced in the 80s. And I honestly think there's a lot of things that are legacy in this business that we talk about economics, and it's so the 2 and the 10-year have been looked at for a long time, and we have data going back much further. In fact, there's more data than this, but this is just what's here in the archives. So we use that because we've had it, and it just sort of, well, the 10 and the 2, because the 2 is, the shortest term one that we have available, or the one we have good data for. We just didn't have good data, and people just kept using it. So people still talk about the 10 and the 2. I don't think the 10 and 2 is the important one. I think the 10 and the 3 is, and it's more than just my opinion. There's actually data that support this. But what we're looking at here is when we do see an inversion of the 10 and the 3, it means that the yield on short-term bonds is higher than long-term bonds, which is not usually the case. And so there's sort of this question is that a leading indicator? Is it correlated, or is it the cause? Which is causing which? Is it the economy that's causing the yield curve to invert, or is the yield curve inverting causing the problem in the market? I think the answer is a little bit of both.
Because you've got some situations where, this will be an indicator, and bond prices have dropped, obviously, with an increasing, yield on across the spectrum right now, but they're dropping faster on a shorter term basis. And so what's going on is you have a lot of portfolio managers out there, and I'm talking really big passive amounts of money that are out there at Vanguard and State Street, and huge trillions of dollars of money that have set parameters in their ADP, their defined practices of how they're supposed to invest. And usually the standard one that most of all of you are used to in your 401k is a 60-40 split, right? Well, if all of a sudden your 60-40 gets out of balance because bond prices have been dropping, well, they have to rebalance at least every quarter. And they don't all want to do it in the last minute of the quarter, so they try to rebalance a little more actively. So if bond prices are crashing like this, that's causing yields to spike, sometimes they're forced to sell the S&P, even though they don't necessarily want to, because maybe earnings are good, there's high demand for products like we're seeing at Apple. I know we'll talk about that here in a little bit, but to go to your point, Eric, that sometimes the signal itself is what causes the selling rather than the other way around.
Yes. So in these things are, like I said, they're the reason we care about this. I think it's a very good question. Whenever you're talking about anything here is the big why. And that is because we're looking for things that are giving us an indication of, are we going to see a market downturn? And are we, do we expect it to continue to run deeper? And maybe have we found a bottom? And we don't have all the answers there. But I think it's helpful from the yield curve to look at, this is a chart that I put together using some statistical software called R. So R is something that is able to crunch a lot of data. And this file right here is 10 megabytes. It just about brings my computer to its knees, but it's pretty neat. And what we're looking at is, if you look at this leading edge here, that is the yield rate of a 3-month, or I'm sorry, a 1-month Treasury. And then the next row back is a 3-month, and then there's a 6-month, and all the way into the back to 30 years. And this data goes back to 2000. And when we think in history of the big recessions that we had a big one, of course, in 2000. We had the big one in 2006 and 2007. And we also had one here in 2019. And this is a little bit controversial, but there are economists that are on the same page with this. that these indications of a yield curve inversion were happening well before COVID. In fact, where this fell off the cliff, that's February 2020 when things started getting really crazy. And we actually fixed the yield curve by lowering the front end. But there were people who were calling for recessions here. So this data,
I was one of them, by the way.
I was too, and I got recognized by the Chicago Federal Reserve for doing that. And I know you and I were at one of those events, and I remember talking with Don Rissmiller from, I think it's Risk Bridge, or I apologize for the company, but I remember having that conversation. Strategist, that's it. Yeah, they provide outsourced research to hedge funds. So when we look at the yield curve and we're talking about inversions, so sometimes it's difficult to look at these data. It's difficult to put them in 3D software. And that stuff that I just showed you, when I push go, it takes about 5 minutes for my computer to process that data. We can look at the data using Excel. And Greg and I were before class, before this session here, I had to delete a bunch of data because it was bringing this graph wouldn't work. It'll only do a couple years worth of data, but that's the same chart using Excel. Here's looking at it from different axes. But here's that 2019 inversion where the front end of the curve is going higher. And if you look historically at all those yield curve inversions, they look different than the one that we're having now. We're having a yield curve inversion where the fronter parts, you can think of this as sort of a mountain range, right? And you've got a valley, and then the mountains go up in the back. And when we have the mountains high in the front, that's when there's something bad. But this doesn't look like the same sort of inversions that we've seen in previous yield curve inversions. And this is what's happening right now, is we're getting some strange stuff that's happening. And I believe this is due in large part to the fact that the Fed now owns 1/3 of all outstanding treasuries and all mortgages. And so we're seeing the Fed starting to unwind in what was called, now it's called quantitative tightening, which is the reverse of quantitative easing. The Federal Reserve balance sheet, and I'm not passing any sort of judgment here. Is this good or is this bad? It's just an is thing. The Federal Reserve happens to have $9 trillion. Well, it's 8.8 trillion today. Let's call it 9. What's with a few hundred billion, right? We're 9-ish and we're starting to roll off. So what's going to happen here? Greg, what's going to happen here? How is this going to go away? Where does that money go?
Well, it goes, it essentially disappears.
Which is where it came from, right?
Which is where it came from. I mean, just as an example, we're starting to see signs right now. And I just think we're, just like this chart shows, we're at the top of this iceberg still on the correction in financial assets. Let me just read you some stats today about our housing market. Houses are selling below their asking price for the first time since 2020. We're finally seeing the housing market. People are having to finally cut prices. Nobody's bidding prices up anymore on homes. They're coming down. Housing starts in July. We're down 19%. Inventories at its highest level since 2020. Existing home sales down 26% in the last 6 months. And the average mortgage payment is up almost 50% since last year because of this interest rate increase. So that's where it goes. We're going to see asset prices, not just bond prices, not just stock prices right now at real estate, because that's what the Fed did. And you said it really well, that the Fed, we were already going into a potential recession or an inversion of a yield curve, which has been this predictable indicator. We were already headed there in 2019. And then when COVID happened, the Fed did the unthinkable, and it saved the economy. At least in the short term, it did, right? They pumped an enormous amount of money and completely distorted true price action in the bond market, especially in the bond market, but in the mortgage market too, because as you said, they own so many mortgages. as part of that, those assets under management, or the assets under management, the balance sheet that they've got there on their books. Now that they are stepping away and they're not there buying, and they may not necessarily be actively selling, right? They're letting just a lot of those bonds roll off their balance sheet. But in essence, that's the same thing, because they're not buying anymore. We're now still trying to see what is the true demand for bond prices. And I don't know if we can determine that yet. There's still so much cloudiness, I think, in the true demand for bond prices. We may be 3 to 6 months before we really see, as the Fed starts to really pull the liquidity out of the market, where asset prices are going to go, how much further this correction in asset prices will go. Maybe we've put in a bottom. Maybe June's put the bottom in. I don't think so yet. I'm hopeful, but I don't think so.
And in the past, we've also mentioned the fact that there's this reverse repo agreement, which is essentially a representation of extra money that's just floating around out there. And this is to help banks due to the Dodd-Frank law that they can only have so many assets. And so overnight, they actually give money back to the Fed, and the Fed gives them treasuries in exchange for that. But there's an interesting article in Barron's this weekend, and the conclusion was that we've got different parties that are acting differently in here, and who's using this money and the money that's coming off of here, that there could be some disparity, and the Fed doesn't quite understand how this is all going to play out. And there's some fear. And this was from Joseph Wang, who's a former Fed, worked for the Federal Reserve, was a bond trader for the Federal Reserve in New York, that we're not exactly clear, and the Fed's not exactly clear how this unwinding is going to happen, and how is it going to play out. He's sort of raising the red flag that we could see issues. You shared that article with me over the weekend. Do you have more thoughts on that?
To clarify the depth of the question, the really question is where it's going to come from. If that excess liquidity, which again is that measurement of the Fed repo, the reverse repo window, if that money just comes out of that excess capital, then it's probably not going to impact the economy much. It won't impact liquidity much. Therefore, bond prices can truly find a true supply and demand, which still may have its own issues, right? But the concern he brought up was it may not come out of there initially. The pressure may actually come from the actual bank's balance sheets. And if that's the case, we could see some banks, although they're fully flush with capital right now, we could see some liquidity issues that start happening to banks. And if, as you've gone back and studied, I know most of you have, right? Y'all studied the 2008 financial crisis. Bear Stearns' issue wasn't that they were necessarily completely wrong. They just ran out of liquidity and no one was willing to help them. Same thing with Lehman Brothers. When they went under, it was a liquidity issue that ultimately caused them to go under. The Federal Reserve and Warren Buffett, for that fact, are the ones that bailed out Goldman Sachs. That's the only reason Goldman Sachs didn't go under at the same time. He's not necessarily saying that that's going to happen again. It just raises a red flag. We don't know. The Fed doesn't know what's going to happen. As they step away from the table of being the buyer is where the liquidities that's going to have to flow back in to buy those bonds, right? Because here's the other issue. He brings this up in the article. In 2008, even in 2015, but especially back in 2008, the demand from Treasury to finance the government was a third of what it is now. That's the other issue. So not only has the Federal Reserve stepped back as the buyer, the Treasury is asking for more. Our deficit is running at $1 trillion a year right now. And so the government wants more. The Fed has stepped back from giving it to them. Will China step back in? I don't think so. Not right now, not with the political tensions that are going on. So that's the big unknown in the bond market. And, you know, we'll see. It will be, and because of that unknown, it's hard being a bull right now. I'll be honest. I mean, those of you guys who've watched me for a while probably know I'm kind of a little bit of a perma bear. At least I have been for the last few years. But it's hard. There's a lot of concerns right now in the liquidity of the bond market as the Fed steps away, whether they can manage that soft landing. I know you're more of an optimist, Eric. That's why I have to talk to you all the time.
Yeah, well, I mean, I look at, go back to 2000, long-term chart, and these little pullbacks seem like, in hindsight, like, geez, why didn't I buy there? But realistically, you mentioned 2015 and this double dip that we had. That was a painful couple of years there, and then the second one really threw a lot of people like, oh, maybe we are going to have a big pullback. And this spike was COVID, and here's where we are now. And how is this going to play out? I love it when we get together and we do the events and you ask people, what's your sentiment? I know you go long term. I know you 20 years from now, 10 years, 1 year from now. And universally, everybody long term is bullish. And some of the stuff you're talking about, and the scary level of debt and deficits are definitely things to scare us. And I think the point is now, I was thinking over the weekend too, after reading this story, is that there is clearly something different in what's happening right now. And those are some of the most dangerous words that you can say in economics or in stock market, is this time is different. But there's unquestionably, going back to looking at previous yield curve inversions, that they tend to have here's three of them that have the same sort of shape. Now, maybe the magnitude's different. What's happening today, this is the longer term data. I'm going to go back to the spreadsheet that I have over here on Excel, is this sort of inversion that's happening right now is different than any other yield curve inversion we've ever had. And it is due, unarguably, in large part, due to the fact that we have this massive quantitative tightening, which did happen, of course, in 2008. We did have the Federal Reserve own most of the Treasuries back then, but we actually pulled through that quite well. And what's happening right now is the Fed is trying to manage through loosening or tightening, doing the reverse of the quantitative easing. They're trying to let the assets that they have, and those are the fact that they own a third of all mortgages and treasuries. They are putting permutations in the market. They are making the market move and do some weird things. And there is plenty of reason for people to be to have their spidey senses up, that something's different right now. And almost always when something's different in the market, it's not a good thing. It can be played out as a very bad thing in the market. I'm in the camp that, I don't necessarily support this from my political, but from a personal standpoint, we have the most accommodative Fed that I've ever seen. And I don't think that they care as much about the market right now. I think they're going to let the market pull back. But I think their bigger focus is on trying to get this soft landing. And they have their hands on the reins on quantitative tightening. I think they're going to let the market, if it needs to pull back, they're okay with that. What they're going to be looking at is the bigger stuff that's more important. And they've been pretty freaking clear about what's important, and it's inflation right now.
Yeah, that's why the CPI report tomorrow is such a big deal.
Yeah, we should probably do another one of these tomorrow. And this is a little bit long-winded for some people, and maybe too much data. So let's take it back to something that's a little bit maybe more digestible. And it just so happened last week that I ended up getting an article from Y Charts, a pamphlet that came from Y Charts. And I'm not going to distribute this. I'm sure Y Charts has it available. And the reason we're talking about the sort of stuff that we talk about is we want to be able to predict market movements. And they did a study looking at which leading indicators best predict market declines. And they did this study based on objective data, looking at some very popular sort of signals. And we're not going to go through each of these. I would encourage you to to get the article, download it, read it, or do some Googling on us. There's the Buffett Indicator, which looks at total market cap versus the S&P 500. And then there's a Tobin's Q. There's an S&P 500 PE ratio, price to earnings ratio. And then there's a CAPE ratio, which is from Schiller. There's the 10 and the 2-year spread, which is what we started talking about here earlier. A lot of people look at the 10 and the 2-year. And then there's a 10 and a 3-month, and then the S&P 500 year-over-year earnings growth. So something like Howard Silverblatt does a spreadsheet to look at this sort of stuff. And what they've done is gone through, and here's the key takeaways, which I'll just summarize on this one down here in the bottom right-hand corner, is that the 10 and the 3-year has consistently been the best indicator. And
3 month.
10 and 3-month. Thank you for clarifying that. The 10 and the 3-month has been consistently the best indicator. And you can, I'm not going to steal the thunder from Y charts, but they've got plenty of data to go through and indicate why. And I do think it's a little bit of not only is an inverted 3-month and a 10-year an indicator, but it can actually be the cause. Because banks borrow at the short-term rate, which is closer to the Fed funds rate. So the 3-month, the 1 month is essentially the same as the Fed funds rate, and the 3-month is closely tied to it. So as the Fed raises rates, it's going to raise the front end of the yield curve. And when you have banks borrow money at that Fed funds rate, and they loan it out at other rates. So credit cards and mortgage rates and personal loans are all more closely tied to the 10 and the 20-year. So they're not exactly the same, but when the bank is paying more money and then it's loaning out, that's bad for business. So I think if you want to look at one indicator, I'm going to tell you that it's the 10-year Treasury minus the 3-month. By the way, if you want to go to Fred, this is the St. Louis Federal Reserve, so .org/series. It's the T10 Y3M. So it's the Treasury. Treasury T10 Y. So 10Y 3M. So it's the 10-month, 10-year and the 3-month. I apologize. So 10-year constant maturity, you can get this and look at it for yourself. And people were freaking out that we were getting close to an inversion. Remember, we did get an inversion on the 10 and the 2-year. And that's got some people, and that is an indication that there's some things that are broken. But in terms of looking at the overall, are we definitely going to are we in a recession? I think if we're going to have a recession, I think it's going to be one of these kind of recessions where it's so thin that you're like, what was that? People are saying we're in a recession. Maybe we are, maybe we're not. The question is, how much longer? Is it going to be a prolonged recession that's going to continue? I'm in the camp that it's not. Right now, the data will change. The data could change, and I'm okay with that. But I would say that if we are in a recession, it's mild, and we're probably looking at getting through it.
If Apple's pre-sales are anything at all an indication of whether we're in a recession or not, we are not in a recession. We talked about Apple the last time we talked, and we talked about their new product announcement, and I said how I like the purple. The new watch we talked about, their demand is fantastic. In fact, you're seeing Apple pop. It's up 4% today because we're seeing their demand for their products outscaling, and so they're having to push delivery dates out further and further. And so, yeah, I think I agree with you. As long as real estate doesn't collapse, that's the big unknown. That's where the soft landing is important, right? We have to get a real estate market that's going to, it's okay if it corrects, right? We just can't have a collapse like we had in 07, 08. Not that the leverage is there, but there's been a lot of study about wealth effect too. And ironically, people's wealth effect in their stock portfolios don't impact as much as the wealth effect in their home does.
There was data actually, I think it was in Inversions over the weekend, that talked about this specifically, that when when you perceive the value of your home going up, whether you're going to buy or sell, you will spend more money in the economy. So that's, did you catch that this weekend too? I think
I did. Yeah, I read that as well.
I forget exactly what the number is, but it's something like every $10,000 is another $10 that you'll spend a month or something like that. So
we have to, as long as we don't have an epic collapse in real estate prices, I'm in the camp that yes, this will be a blip recession. If we have a pretty severe collapse in housing prices, I may change my mind on that.
Yeah. Well, I mean, it's okay for you to be a bear. We don't have to agree. And I'm just going to go based on the data. I also think there's other stars aligning, and we talked a little bit on the last one about politics that, things are going to get ugly here until November. But I think come end of November, December, I would expect the market to be trending up. But I'll change my opinion when the data happens when we get there. Forecasts are forecasting. It's not so much about being right, it's about what you do with it. So having a plan to adjust is, I think, where you need to be. But that's real quick on the key takeaway, I think, for today's show. So we should probably just keep it short, and maybe we can get back tomorrow to talk about CPI. And that is, hopefully we help people understand that, what's a treasury, what's the yield curve, what is a yield curve inversion. This is the place that I would, if you don't want to do the 3D, charts. And if somebody wants the charts, I can probably make them available for you to look at. They're not as much fun as they may seem. They're a lot of work, and they're pretty. And maintaining them and keeping them up to date is a bit. But if you want to look at one thing, this is the indicator that I would look at. And you have good reason to see that, earlier this summer, we saw this thing crashing down, looking like it might head for an inversion. The 2 and the 10-year inverted. And I'm going to go back to here, that if we look at this leading edge, we saw some weird stuff happening, and that's all related to, well, it's simultaneously two things going on: the Fed announcing that it's going to raise rates, but the letting equities roll off their balance sheet, the mortgage-backed securities and treasuries that they own. That is definitely impacting the market. They were the biggest buyer. 25% of all outstanding treasuries are owned by the Fed, and those were all purchased, in the past couple of years. So they were the market, and now they're no longer there, and that is causing some ripples throughout. And in your spidey sense should be up, because this is definitely different. And is it a good thing or a bad thing? My argument is that the Fed isn't going to let it be a bad thing, because they have controls on it. They may let the market go down, but they're not going to let the economy crash. Yep. That's my read on it. And so I'm going to trade it and keep an eye on it. That's why it's important. I think it's a healthy question, by the way, whenever anybody's asking you or telling you about something they're looking at. I think you've got permission to come back and say, why is that important? Why should I care about that? Because there's a lot of things to worry about out there in the world, and some of them are not important.
Okay, let's get together tomorrow. CPI will be interesting tomorrow. That's still the driving factor, right? What the Fed's going to do. I think the latest number I saw was 92% conviction that we're going to have a 75% basis point hike at the next meeting, and maybe that'll change.
Yeah, so that's the
based on the CPI tomorrow.
The CME countdown to the Fed. This is something you should keep an eye on. So tomorrow there's a 92% probability of the September 21st meeting, but looking out maybe to December to see if the numbers shift here. We're looking at it looks like the probability of a rate hike is kind of shifting up, because this was 20 yesterday and now it's 22 today. All right, today's Monday, isn't it?
Today's Monday.
It feels like it should be Tuesday or Wednesday. Yeah, so keeping an eye on this to see if it shifts anything based on the CPI number. I honestly think it's all priced in, and so
me too.
Bad. And so what we're watching tomorrow at 8:30 a.m. Eastern time is the CPI look to see. This is Econo Day, and it's slowly loading. So the month over month consensus is for a -1. The year over year is at 8%. So the consensus range will be interesting to see. It's not always about what the number comes out, it's what the market expects. So if we get numbers that are on the either end or outside of this range, we're likely to see the market respond tomorrow. But I think if we're near these consensus ranges, we probably won't see any impact. But let's talk about it tomorrow.
Okay.
All right. Thanks, Greg.
Thanks, Eric. It's been a pleasure. See you guys.
See you later. Bye.
Don't forget to subscribe and like.
Like and subscribe. Thanks. See you, everybody.